Are stocks safer than bonds right now? I know, it sounds like I misread the teleprompter. As I speak, stocks are in a nasty correction, and Treasury bonds are everyone's safe haven as they were in 2008. But what if the market's reaction is partly overreaction, more post-2008 traumatic stress syndrome than a clear-eyed vision of the future? Stock investors are focused on the possibility that the currency crisis in Europe means the U.S. will lose exports, and without that help, the economy will dip into Great Recession Part 2. But even a 30% decline in the euro against the dollar would shave only 4% off the S&P's earnings. Meanwhile, those earnings projections are still on a sharp uptrend on the strength of the U.S. rebound alone, and on the cost-cutting that most companies did during the recession. So if the economy avoids a double dip, stocks should find their footing again. As for bonds, well, as they lose their safe haven status, prices will come down. That's what was happening before this whole euro mess started. But suppose the economy does double dip. Even then, bonds aren't necessarily a bargain. How will Uncle Sam respond to recession? By issuing another gusher of treasuries, eventually crowding out other borrowers, raising interest rates, and risking a credit downgrade. In other words, if the economy turns out much better or much worse than expected, bonds lose. And you don't exactly get rich for taking that risk. A whopping 3.2% on 10-year bonds and 0.7% on the 2-year note. High-quality stocks, meanwhile, will pay you a dividend of about 1.8%, plus a lot more upside if we avoid recession. Now, there are still plenty of reasons the stocks could fall. But if the events of the past few weeks have left you sure that now's the time to bail out of stocks and load up on bonds, think again.